earnings of two big banks. ICICI Bank and HDFC Bank have reported earnings, while on one hand, HDFC Bank has seen improvement of 6.7% in bottom line. ICICI Bank has increased its net profit by over 18%. If you talk of margins front, on HDFC Bank, 3.4% NIM remained this time, and ICICI Bank has posted a NIMs of 4.1%. But deposit growth remains steady for both the banks, 14% each for ICICI Bank as well as HDFC Bank. The difference is in loan growth. On one hand, HDFC Bank has reported a loan growth of over 4%. ICICI Bank has seen impressive growth of over 13%. To decode these numbers, we have with us Editor-in-Chief of ET Now and ET Now Swadesh, Nikunj Dalmia. Nikunj, welcome to this special show. How do you make out of ICICI Bank, HDFC Bank numbers? Do you think this opening partnership will help markets as well as banks?
So Ankur, I'll tell you prima facie why these numbers are important. HDFC Bank and ICICI Bank, if I look at the total market share between these two banks, Ankur, I think it is almost 35% plus. So we are looking at what 35% of the banking system has actually done. Now again, the Q4 was an important quarter. Why? Because markets in a sense were hoping, and which is what they've got, that there should be a marked improvement between Q2 versus Q2 and Q3 versus Q4, which is where they've demonstrated. Now bear in mind that for the first time, we had seen an impact of easy liquidity which had come into the banking system after the change of guard at Reserve Bank of India. So on that front also, markets were hoping that there would be some logical extension in terms of the quarterly performance. On that count, if you look at the big picture, without getting into real specifics of the number, because that you and Gaurav have been covering brilliantly, the idea is that to first look at the big picture, which is that two large banks of India, 40% weightage broadly between them, 40% market share broadly between them, more than 20% benchmark weightage in terms of Nifty 50, they've delivered. Directionally, these two banks are doing well. That technically means that the sluggishness in the economy, which in a sense was supposed to be the big concern, at least for RBI and for markets, that seems to be getting arrested. Then you look at the deposit ratio, the liability franchise, which is all we know has been the pain point for banks, and that's where also you just spoke about the numbers. They seem to be incredible. Now, you have to bear in mind that we are looking at these stocks just sitting at an all-time high. State Bank of, HDFC Bank in last couple of days has just done a pole vault kind of a jump, and it is hit a new all-time high. ICICI Bank has been a ranked outperformer. So you add these things up, because banks are doing very well. And on top of that, the weightage of these two stocks in the bank Nifty is very high. So net-net, these numbers in a sense will suffice the need of brokerages to keep their price targets revision upwards. If these price targets are revised on the upside, then banking emerges as a clear safe sector in this kind of a market where IT so far has disappointed and nobody is expecting anything large from other global sectors, at least because of what is happening in the tariff war. Ankur?
So one thing specifically about HDFC Bank, Nikunj, the market has been talking about margins for a very long time. This quarter too, it's 3.4%. What do you make out? Do you think that management commentary, which is now saying that they will be able to maintain this kind of NIMs even in the environment where repo rate is going to decrease? How should market read these numbers now?
Markets would be not excited, but they would be satisfied, Ankur. Why? Because HDFC Bank has gone through its, merger pain, so to speak. And exactly 2 years ago in the same quarter, I think it was in the Jan quarter, they decided to really slow their growth down. Why? Because they wanted to reprice the deposits. Now that they're committing to a margin picture, which is north of 3%, then NIMs will come down because of cut in repo rates. That means they're expecting operational efficiency to kick in. Because if the spreads are high, and if you are going to be enjoying less margins when you're lending, that means this is a function of either long old liability of the banks which have retired, or you're confident of getting CASA on a continuous basis at a much lower pace because the CASA also has been cut by most of the banks. So these numbers may not warrant extreme strong upgrade, but they will keep the momentum going for the stock now to sustain. So gradually and slowly, I guess the banking sector which has come back into focus, I think that focus area for banking now will remain. For me, I think the big takeaway, Ankur, is that if I look at these two banks as a benchmark of the economy, which is what I always say, that look at the canary in a coal mine. The canary in a coal mine are these two large banks. And these two large banks between them, Ankur, I mean, correct me if I'm wrong, I think they would have a market share of at least 35%. I think HDFC Bank is 22, and you add another double-digit number for ICICI Bank, it makes it about 35% plus. 35% of the banking sector per se has demonstrated agility, growth, as well as quarter-on-quarter growth. I think year-on-year, Ankur, doesn't matter. The quarter-on-quarter number on the liability front and also on the growth front and the NIM front, I think it's very steady. Ankur?
One last question, Nikunj, specifically on ICICI Bank. You have seen the profit numbers, you have seen NII numbers, even NIMs are 4.1%, which is higher average of industry. And you talk of deposit and advances over 13%. Do you think it is all tick marks there?
See, all tick marks does not mean the stock is going to go through the roof. A lot of good news in ICICI Bank is already in the price. And also we need to be cognizant of the fact that some of the subsidiaries of ICICI Bank have gone through what really could be called a cyclical slowdown, especially the insurance subsidiaries, especially the security subsidiaries, which will go through a slowdown given where the market conditions right now are. So while banking business of ICICI looks to be bulletproof, but then you look at the sum total of ICICI Bank, all subsidiaries of ICICI Bank have to really fire full cylinders for us to get that kind of a picture. But again, to grant it to ICICI Bank, stock per se, it's not very expensive. Ankur, valuations are not very expensive for any of the large private banks. And with FIs coming back after clarity which has emerged on the tariff front, I will not be surprised at the kind of momentum what we've seen in banks and large private sector banks. I think that will continue. So FIs are coming back with the hope that the cyclical slowdown in India is over. When the slowdown happened, retail NPAs did not come in. The cost of capital is now going to be down because repo rates are coming down. And also, given the liquidity in the system right now, the flow of money into the system, the liquidity surplus, it's much more easier per se. So this is a sector where I think more than anything else, I think it's going to be an extension of the rally what we've seen in the last couple of days. Post these numbers, I think that is only getting endorsed now. Ankur?
One concern which was there, especially for banking, was how Q4 numbers will be. Will there be loan growth which will be continuing? But more than the numbers, if you see, Nikunj, the commentary, that is positive. Even on Yes Bank numbers, the management commentary is there. They have grown by only 8%, but they are confident of growing to over 12% next year. Similarly for ICICI Bank as well as HDFC Bank. So do you think these numbers, although these are initial, will provide some respite and direction?
So you also have to bear in mind that what we're discussing are March end numbers. And the tariff got implemented only from April. But today when managements are giving the forward commentary, they're including the tariff uncertainty. So despite the tariff uncertainty, the kind of numbers you spoke about in terms of growth, albeit, Yes Bank has a small base, but what ICICI Bank has demonstrated and what HDFC Bank is indicating, I think it is nothing short of impressive. I won't use the word spectacular. I won't use the word sparkling, but I would say impressive nevertheless with a positive bias. Now, these are not the banks which will do cartwheels, Ankur. I mean, they are not small banks. They are widely owned stocks. But, a little bit of upgrade now will just keep the momentum going. So my sense is that now banks, at least the large banks, are in that zone where they would move in line with earning expectations. Earnings for banks, the big ones, would be higher than the nominal GDP of India. The higher nominal GDP of India is about 10-11%. So banks which have a credit growth of in and around the nominal GDP plus 2%, plus you add that multiplier of cost of capital coming down and add the NIM expansion which kicks in. For FY26 and FY27, these banks are very reasonably priced. When I say reasonably priced, don't expect spectacular stock returns, but steady returns when the world is marred with uncertainty and world is marred with, tariff problem. I think this becomes a defensive sector. I thought I would never use the word defensive for banking, but, IT is in a mess. Global sectors are in a mess. Trade tariffs are at play. You don't know which way the cookie is going to crumble. So banking is a very local business. And with FIs coming back, typically I've seen banks outperform. So the whole tint of stable, defensive, FI coming back, steady number, and a marked improvement in Q3 and Q4. The trajectory is what looks very impressive to me. Ankur?
All right, thank you so much, Nikunj, for joining at this hour. So definitely, this is a start, as Nikunj summed it up, that in the initial run, you would have seen that these are impressive numbers, but there are global uncertainties. Having said that, banks work on local issues, local things matter. But if you see the commentary of ICICI Bank, you see commentary of HDFC Bank, they remain positive, but of course with the concern which remain on the global front.